The S&P 500 printed a fresh record high yesterday as softer jobs and U.S. inflation data continue to ease the Federal Reserve rate hike expectations and hence push short-term yields lower. But whatever this week's data says, inflation remains elevated in the US. July's easing was helped by lower oil prices, but renewed Middle East tensions threaten to revive price pressures again. Meanwhile, rising US debt levels, structurally rising long-term yields, and increasingly attractive Japanese yields complicate the outlook for global borrowing costs, and strong earnings, AI investment, and energy profits continue to support Wall Street, but geopolitical risks, the shift in Japan's rate outlook, and higher energy prices look like ticking bombs. So welcome to Swissquote's Daily Market Talk. It's Friday, 14th of August. I'm İpek Özkardeşkaya. We will talk about the good, the bad, and the ugly of the financial markets. But before we do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So let's start with the good. The S&P 500 traded at a fresh record high yesterday as this week's US inflation data showed easing in July numbers. On Wednesday, the Consumer Price Index in the US printed a retreat in both CPI and core CPI figures to 3.4 and 2.5%. respectively, while Thursday's Producer Price Index in the US showed that the headline PPI fell sharply to 4.7% on a yearly basis in July. That's down from 5.5% printed a month earlier and well below the 4.9% penciled in by analysts. Core PPI is to 4.2% level as well as expected by analysts from 4.7% printed a month earlier. Now, the numbers are good, but I see two issues with these numbers. First, they remain comfortably higher than the Fed's official 2% target. Now, no one knows if the Fed, under its new governor, Kevin Warsh, will continue to look at the traditional inflation metrics to determine where the rates in the US are going. But at the current levels, US inflation remains too high to ignore and certainly too high not to hike the interest rates. Kevin Warsh himself had expressed concerns about US inflation running persistently above targets since half a decade in his first press conference. I know that things may have changed since then, but the fact is that the US inflation is running well above the Fed's 2% official inflation target. And two, the easing in price pressures in July was clearly driven by a sharp retreat in oil prices on Middle East hopes at that month, but since then the tensions flared up again, pushing oil prices significantly higher. As such, this week's optimism regarding the fading inflation pressures looks somewhat disconnected from the reality. If the reason why we see the market rally is because US inflation worries ease in July, well, optimism could fade away quickly. But happily, that's not the only reason, and we will talk about that a little bit later. But nonetheless, the Federal Reserve rate hike expectations for September are melting like snow under the sun these days. Last week, activity on Fed funds futures was assessing more than 60% chance for a September rate hike, remember? Today, after a set of soft jobs and inflation figures from the US, that probability stands at only 32%. The US 2-year yield that captures the Fed rate expectations actually eased 25 basis points since its July peak, and the US dollar has come under fresh selling pressure since the Federal Reserve's latest July monetary policy decision, where the new Fed chair Kevin Warsh turned from not willing to make forecasts in a crazy geopolitical environment, which was fine and understandable, to clouding the Federal Reserve's reaction function to inflation, which is less fine and less understandable, of course. Today, we don't even know if the Fed's priority is to tame inflation or just make the market absorb lower interest rates as smoothly as it possibly can, hoping to help ease some of the weight of the growing interest payments on exploding US debt at a time the confidence crisis obviously in US institutions, including the US government and the Fed, on the deepening Middle East war, and the fact that the US government will have to spend more, the exploding debt levels already before the war, government's push for more spending, and clouded Fed policy, while all these pressure the longer end of the US yield curve higher in a structural way. And even with a robust AI-led growth, robust government spending, and the US government's efforts to narrow the trade deficit, which both are Supportive of the GDP, the US debt to GDP ratio returned to the highest level since the pandemic months, and the latter is having a serious impact on US long-term borrowing costs. Not helping at all, Sanae Takaichi, the Japanese PM, who is famous for her explicit preference for softer interest rates and robust government spending to boost growth, is facing the ugly reality that the interest rates in Japan must be lifted to ease the persistent selling pressure on the Japanese yen, which in return is probably hurting the Japanese economy today more than higher interest rates would. The latest news suggests here that the Japanese government is now turning supportive of a near-term rate hike from the Bank of Japan, making a September or latest an October rate hike highly likely. As reaction, the Japanese 10-year yield is pushing above the 2.85% level today without, however, pulling the dollar-yen lower. And in terms of Japanese yields, we are now more than a full percentage point above the levels that investors thought would trigger a reverse carry trade. It did not so far, but that remains a big scare that more appealing Japanese yields will, at some point in time, potentially in the near future, trigger a reverse carry trade in yen positions and pull the rug from under the feet of the US sovereign bonds at the worst possible time when the Fed is forced to cut interest rates or at least not to hike them. As such, after a US 10-year bond sale printed the highest yield since 2007 earlier this week, yesterday's 30-year auction drew the highest rates in 25 years. The yield came in at more than 5.20% for the 30-year paper. To say the Fed can't lower the borrowing costs alone. There are many external factors like geopolitical tensions, cross-border asset flows, and sovereign debt trends that impact borrowing costs. But the good news for the Fed is that it could eventually have a say on the yields by acting on the interest rates. The problem is that the Federal Reserve can't just lower the interest rates if the data doesn't justify lower interest rates. I mean, it could lower the interest rates if it wanted to, but the yields wouldn't come down if investors think that this is not the right thing to do. So the early hawkishness from the Federal Reserve, which had triggered a broad bond sell-off in the US and across the globe, is today being retraced on soft US data, and that's the good news for the markets, and the latter echoes positively across the major US and European indices, also lifting the Asian indices along with strong earnings, of course. Main Street may be grappling with rising price pressures, but Wall Street is thriving today despite the Middle East war, the energy crisis as a result of it, and the trade frictions. In fact, the chart from Bloomberg shows that the S&P 500 companies' earnings are growing faster today than their stock prices. In reality, the war and the energy crisis helped the energy companies have a great quarter. Then the AI craze is also boosting revenue at big technologies cloudiness, as we saw in the earnings season, and their investments. So big technologies' massive investments has a massive positive impact on AI enablers and construction companies. So that means that many companies out there today are getting their fair share of the actual energy crisis and also the AI investments, therefore not being invested scares investors more than a few downside corrections down the road. On the geopolitical front, the lack of progress in US-Iran talks this week, and news that Iran is now shifting toward a more offensive stance, didn't necessarily trigger a proportional positive reaction in terms of oil prices. US crude topped near the $85 per barrel level earlier this week and is coming lower since then, and that despite the lack of further progress. The muted reaction this week is obviously good news, but the latter could also be a ticking bomb. Indeed, we start seeing that the European Stoxx 600 index is now feeling increasingly uncomfortable with the rebound that we see in energy prices, and they could well enter a period of extra caution as higher oil prices also increase the chances of a European Central Bank action, likely weighing on stock valuations near their all-time high levels. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week, and until then, good day trading and have a lovely weekend.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.